right. Good afternoon. Good afternoon. How is everyone doing out there? How are you guys doing out there on this lovely Thursday afternoon? Hey, the week's flying. It's already Thursday. I hope everybody's having a wonderful time. Hi, Ness. Thanks for jumping in here. Good afternoon. Good afternoon. Hey, Laverne. Good afternoon to you, too. Oh, let me go live on IG. I always tend to forget these folks over here. Let me make sure that they're on. Hi, Brianna Bud. Good afternoon. How's everybody over here on IG? Thanks for jumping in here, you guys. Hey, Brianna. Hey, Margie. How you doing? Thanks for tuning in. You guys hit like and share on this video. Get all your folks up in here. Karen Jones, afternoon. Elaine, how are you? I am awesome. Thank you, Karen. How are you doing? Hope you're doing just fine. How are you today? Thanks for tuning in, guys. Hit like and share on this video. Get all your friends on board today. This information is very, very important. A lot of people is interested in how they can purchase real estate. I've gotten a lot of calls this year. People are planning on trying to purchase real estate either for their primary residence. Some people wanted to get investment property. And, you know, we have been discussing all about building wealth. And so the whole idea here is real estate is a part of building wealth. So we are going to speak on the real estate aspect of things today, how you get qualified to purchase real estate. Some of us feel like we can't do it because it's so far-fetched and, oh, my God, you know, this is just a whole lot. But today we're going to tell you how you can make this happen. I have a guest in the house today. And, of course, she have assisted thousands and thousands of people to be able to get qualified and to purchase real estate. And so we want to pass on this information to you guys and let you guys get a hold of it so you can, can utilize it as well. So in the office today, guys, I have Miss Brenda Robinson, who's going to join me here today. And she's going to let you guys know how you can qualify for real estate. So we're going to talk about 4 different points, different key points of getting qualified. And the first point is going to be talking about credit score. The second point is going to be speaking on your money and income. Of course, we know that that's very important. And we're going to talk about this debt to income ratio. I know everybody hears this debt to income. What does it mean? Ms. Robinson is going to tell us what that means today. And then we'll talk about taxes. You know, of course, taxes have a lot to do with everything we do. We talked about how everything we do has a tax effect. There's taxes involved. And so we'll talk about how that plays into this whole thing. Okay, so all right, guys, hit like and share. So, all right, so let's just jump right into this. We know that there are some things that you have to do to qualify. So the first one we want to talk about, number 1, is credit score, right? The credit score determines a whole lot of stuff as to how you qualify. And of course, again, that's why Ms. Robinson here, she is going to explain to you guys, Brenda, what is the most effect that your credit score have on getting qualified for a loan? Could you just introduce yourself and let the guests knows the credit score, how important it is to have a great credit score?
The credit score is very important, and everyone should know what your credit score is. You can go on annualcreditreport.com and pull a free credit report. You should know when you sit down with a lender like myself, there should be no surprises. You need to know what's on your credit and what you need to do in order to, if you have some blemishes, how to correct it. But that FICO score is going to dictate your rate. It's a factor of your loan to value and your FICO score, and that dictates the rate. So credit is very important. And I really encourage, if you do not have your credit report, go to annualcreditreport.com. It's a free copy you can get from all 3 bureaus, Experian, Equifax, and TransUnion.
All right. Well, there you have it, guys. Credit score. We talked about credit score earlier in some of these live, and we talked about making sure that you stay on top of it. And like Brenda says, pull that score and see what's on there. If there's certain things on your credit score that you need to clean up because it's low for some reason, you guys want to take care of it now before you even think about going to get purchase a home and getting qualified. So you want to look at your credit score, like she said, see what's on there, see what you need to take care of on there. There's line items that you have to take care of. if that's the case, let's do it. Do it now. Take care of it now. Okay. So your credit score can improve. And what we talked about, Brenda, earlier when we talked about credit score too, a lot of times we were speaking of paying how to pay off debt to increase the credit score. We had discussed that as well on here. So, just real quick, maybe you can just touch on that, just
Sure.
one simple point as what could improve that real fast.
Sure. The rule of thumb to get the best FICO score, your balance to your limit should be 30% on you. This is on revolving. Your balance to your limit should be 30% or less. And you're going to get the highest FICO score from that creditor. What you want to look at a lot of times, your balance, your limit, it may be over 70%. I've seen it where it's over 90%. That has a negative effect on your credit report. So you want to take a look at that. Also, you do not want to put items in dispute. As a lender, when I see a dispute on your file, most times that my DU approval is going to ask me to remove the dispute to get a true FICO score. So be careful. I know a lot of people think that if you put it in dispute, then it won't count. Sometimes it will have a negative, many times it will have a negative effect. So be careful of putting accounts in dispute. But I encourage you to get your credit report. If something is not right, write to the bureaus. On there, you can write to Equifax and say, this is not my account. You give them your ID, your driver's license, everything, and what will happen is that they will go ahead and send you out a letter and investigating it, and then they'll send it to the creditor for a response and send it back to you. And this is, I'll be honest with you, I've seen people's score go up tremendously, and the ones who have really got the optimal increase have been ones who have sat down and reviewed their own credit report, know what's on there, and send letters getting items off. So it's
All
really
right.
important to pull that credit report. A lot of people go, there's a lot of credit agencies. You can do it yourself. Just pull
Okay.
that report. There's 3 bureaus. Look at it and write the letters. If this was not yours or this should have been off, write the letters. And
Okay.
your score will
So
improve.
you guys take note of that. Let's work on those credit scores and get them up, because it's going to determine the rate that you will get when you get ready to get qualified for your loan. Okay. So that's the first point today, guys. Again, I want to, welcome the folks over here on IG, Klaus for Pop, and all you guys over here on IG. Again, thanks, Laverne, for jumping in here. We want to welcome you. Hi, Lana. Thanks for jumping in again. Hey. So, number one was the credit score too. Okay, let's talk about income. All right. So, I know income limits has a lot to do with it. It also varies based on what type of programs, right, Brenda, that you guys have. And it's probably has a lot to do with the purchase price. I mean, can you explain to them how the income, can determine what you can get qualified for? So you can, just jump on that real quick.
I teach a lot of home buyer classes, and this is one thing I tell everyone. On a sheet of paper, I don't even have to see it. Just write down what your gross monthly income is. If you write down your gross monthly, let's say my gross monthly is $4,000. Normally, depending on the credit and the LTV, the rule of thumb is normally 45%. But if you take $4,000 times 45%, that means my income can support a mortgage of $1,800. That's including taxes and insurance. So you can take your gross monthly. If you're self-employed, you're going to take your net, you're going to average your net over 2 years. But basically, to get a feel of how much of a property you can afford, if you're W-2, just take your gross, not net, take your gross earnings times 45%, and that's how much you really can support a mortgage. we're going to do a few more things, like minus any debts you have if the bottom line is 45. But that's an easy way to see how much of a mortgage you can afford. And then we just do the numbers of saying, okay, so for about 1,800, you're probably looking at somewhere in the 200,000 for 1,800. Or maybe if you're doing a down payment program, maybe we can get it up to, a little bit higher. But that gives you an idea of how much of a mortgage you can afford, just doing that simple calculation.
All right. So guys, there you have it. Your income determine what you could be qualified for. Again, we all would like to go to the top and get something grand because that's what we, our mindset says. But again, in reality, we need to buy what we can afford because, of course, once you get into the home, you want to be able to maintain the home and you want to be comfortable in making those mortgage payments. So that's the reason why, this whole calculation is very important. So we may have to even maybe change where we want to, purchase at just to kind of fit into the income because some areas, of course, as we know, is a lot more expensive than others. And so we may have to make adjustment there just so that we can qualify to purchase. All right. So a very good point, you guys. Go ahead, Brenda.
Uh-oh. I was going to say, and there's a lot of down payment assistance, especially if you're buying here in LA County. There are city programs that provide up to $90,000 as a deferred second. There's other programs for
rental property and that potential income can
we have a new program if you purchase
for more
east of the 405 freeway.
Okay. So Ms. Sharice, Ms. Sharice had a question over here. She says, can you speak on a rental property and potential income works? How the potential income works in your favor for rental property? I know there's some thing to do with what the amount of rents versus your personal earnings. Brenda?
Well, the guideline now, if you're buying under conforming is Fannie Mae or Freddie Mac. If you do not have a history, if you do not own a property, we cannot use that rental income to help qualify you under conforming. I can still do it under FHA, but under conforming, unless you have a history or a property management experience, I'm not going to be able to use that rental income to help you qualify for that property. And that's
so that means that
okay,
so that means that your personal income have to sustain that mortgage on its own outside of what rental income that you would be getting from that property. Correct? You guys get that? Yeah. All right. So so your personal yes. Okay.
Yeah, I was saying that was a change in the conventional guidelines about 2.5 years ago. Yes.
Oh, okay. All right. So great to know. Thank you, Brenda. Thank you, Elaine, from Sharice. Hey, Thomas Zero. Thanks for jumping in here. All right. All the folks over here on IG, I welcome you guys.
Another thing, if you're buying, and I was going to say, if you're buying under FHA and you're buying rental property, FHA allows us to use 50% of those rents. It used to be 75%. So they're cutting back a little bit on how much of a rental property I can use in order to qualify you for that purchase. So FHA now is set.
Good point. So again, it has a lot to do with your personal income as well. And so they don't rely heavily on the rental income based on what program it is that you're getting qualified under. Okay, very excellent point. Thanks for asking that question. All right, so that's the number 2 point today, guys. We're going to move right along. And hey, Cunningham, thanks for jumping in here. We're going to talk about the third point, and that's the debt to income ratio. Now, we all hear this debt to income ratio. And some of us, it kind of is self-explanatory, but we don't know exactly what it means. So the debt to income ratio, Brenda, can you explain exactly what that means? And, when the lender looks at your debt to income, what are those two things that they're looking at?
As a lender, there's two ratios we look at. One is called the housing ratio, or sometimes it's referred to as the upfront ratio. And then there's the debt ratio. And so what we're looking at, the housing ratio would be your mortgage payment over your gross income if you're a W-2 wage earner, or over your net income if you're self-employed. So that's going to give me a housing ratio. A lot of programs look too much at the housing ratio, but looks at the debt ratio. I should preface this by depending if you're going FHA or if you're going conventional. So the housing ratio is the mortgage payment over your gross income. The debt ratio, or the back end ratio, is the mortgage payment, which includes taxes, insurance, principal and interest, HOA fees if you're buying a condo, mortgage insurance, over plus your monthly debts per the credit report over your gross income. That's the debt ratio. Normally that ratio for the debt ratio under conventional is 45. If your credit is good, sometimes we can go a little bit higher. Sometimes I can go up to maybe 49.9. Normally you cannot go over 50. However, if you're going FHA has a front end ratio that they look at, and that front end ratio should be under 47% to get a DU approval. And that's going to be your principal, interest, taxes, and insurance, plus your mortgage insurance over your income. That's what that front end ratio is. And then when you add in your debts over your gross income, that's going to give you the debt ratio. Under FHA, we can go up to 50, has to be under 57%. And conventional is normally 45, sometimes up to maybe 49.9 with compensating factors.
Okay.
So it's a front end ratio and a debt ratio.
All right. So you guys, I'm sure that sounds like a whole lot, but I think the bottom line here is the less debt that you have, the better off you will be. That's what I gather from this whole thing. So when you're preparing to buy a piece of real estate, you want to try to get rid of as much debt as possible so that you don't have to worry too much about those ratios, because obviously the more debt you have, the more income you need to have. And so the least debt you have, that whole ratio makes a whole lot of difference. So the first thing you want to do, I guess, in preparing to do all this stuff, you want to kind of reduce your debt. And what does that do? Reducing the debt increases your credit score. So all the way around, that's a good idea, right? Right, Brenda? All the way around, that's an excellent idea. So,
and it's going to be able to increase that sales price. Yeah.
Huh? Yeah. What did you say?
And it will be able to help you increase that sales price. I said it, and it will also, bottom line effect, it will help you be able to qualify for a higher sales price.
Exactly. So there you go. So then maybe you can live where you really want to live after all, right? With not having to do too much. Close but Pop have a question over here. She says we need houses, we need courses in this. Unfortunately, this wasn't taught in school. This is needed in school. And Cognac said, I agree, Klaus for Pop. So yeah, so this kind of stuff, you know what? That's an excellent point right there, Klaus for Pop. You know, if this was a class in school, people can plan ahead, you know, as you're in school and, you know, the younger age, you don't have to go through getting bad credit, trying to clean up credit and then do all this stuff. At least you'll start out the gate, you know, being more responsible with your credit, right? Making sure you can keep your debt down and increase your income. And then this will help you qualify to buy real estate. Again, we talked about, you know, for building wealth, you know, owning real estate is an excellent way. So you're absolutely right. If this is being taught in school, once again, you can start early, because what have all of us done at an early age? I think we have all gone through that. I mean, Brenda, maybe you can attest to this too. We all messed our credit up earlier, and then of course, you know, we had to come back, clean it up, and then get started all over again, right? So okay, so that's excellent point, that debt to income ratio.
Really hurts, can I
yes, go ahead.
Can I say something? What really gets me, I've been doing this for over 30 years, and what really hurts me is that when I have a young person there and they have a good job working for Pepsi bottling company or working, a good job. And I try to qualify them, and they have a 600, 700 car payment. And now I can't qualify them for a mortgage because they have this high debt. And I tell them, the day I close your loan, you can run to that car dealership and buy any car you want. But let's get you through the process and get your loan closed. So I agree. This should be taught in high school, or maybe even a lower grade, to teach our people to be able to not accumulate a lot of debt. Another issue I see that happens is the student loans. Luckily, the agencies have come out now and have readdressed how they're looking at student loans, but I've seen that that's kept a lot of our people from getting homes because of student loans, and that could be a whole nother talk show. But these are things we probably want to pass on to our kids, and so that they can generate wealth and buy homes.
Yes. Awesome point. Awesome point. Great. Excellent. Excellent. This is great, guys. Again, like she said, that's a whole nother talk show. This is really excellent. Pan African Film Festival. Amazing. Thank you for jumping on here. This is awesome. I don't even want to move into the fourth point here today, but great information. Cunningham said over here. Perfect. All right, so if you guys, of course, if you have any questions, you gotta put them in the comment. We attempt to answer them. We have Brenda again, like she says, over 30 years she's been doing this stuff. She have seen it all. She have done it all. She have gotten so many people through the process. So many people qualified, some people on homes, and that's the reason why we're having these sessions. Okay, so if you guys have any questions, put them in the chat below, so we'll be able to answer those questions. I just want to move into the fourth point today, guys, in terms of how to qualify to purchase real estate. And this is my expertise, but it has a whole nother new meaning when it comes to qualifying for real estate, Brenda. And this is the taxes, right? So there is a 1 or 2 years worth of taxes folks must have. They must be filed. So can you explain how the taxes have such a bearing and an effect on them purchasing real estate? I mean, without it, I don't know how it works, but
yes,
you can let them know.
One of the first documents we're going to have you sign when your offer is accepted, we're going to have you sign that 4506C, and we are going to verify your the information with the IRS, bottom line. So we pull your transcripts, and we're use that in qualifying. You give us your W-2s, your pay stubs, and all that, but all lenders will pull that 4506, your transcript. And so it's very important that that information is filed.
Okay, and then Brenda, can you explain the standard criteria? Is it generally 2 years of taxes? Because most people hear the 2 years of taxes. I know in some cases, depending on the program, 1 year taxes works. Can you explain to us when that works, and and why?
Oh. Right. So normally, if you're going FHA, we're going to ask for 2 years tax returns. If you're going conventional and you've been self-employed for at least a minimum of 5 years, we can get what's called a desktop underwriting, a DU approval. You've probably heard that term, and it will tell us what's required for your transaction, if 1 year or 2 years. Now, if you're straight W-2, we can get the W-2s and maybe not have to use the tax returns. But I'm the client, I don't want any surprises, so I ask for 2 years tax returns, 2 pay, 2 months pay, 2 pay stubs, sorry, and 2 months bank statements. But depending on how we're looking at it, we might only pull your W-2s. But remember, we are going to pull something from the IRS to validate what we're looking at.
Okay.
And
so
all the lenders will do that.
All right, so that takes us back to 1 year must have your taxes filed. 2, you want to file them on time, so that transcript will be available when they get ready to pull it. You want to file them on time so that they are at the IRS. It's okay for you to say, here's a copy of my tax return. That's all good and dandy. However, the lender will go ahead and have you sign that 45060. A lot of us hear that form number, and that form goes to the IRS, and they'll get an actual transcript of that tax return that's filed, because it is valid once it's filed with the IRS. So there you guys go. Your taxes have to always be done. Make sure that you file them on time, and so that they'll be on record when they pull them. I like to say, just make sure that at least you know there's 2 years that they would be asking you for. So at least be prepared to make sure that 2 years of taxes are at least on file. The last 2 years of taxes are unfiled. You should have them all on file if you had a filing requirement, of course. But make sure at least the last 2 years before you get ready to, try to purchase. So they all have to be unfiled. And I also do know one thing too, Brenda, and a lot of people have this question. So it's like based on your average income, when they pull those 2 years of taxes, they do an average on your income for those 2 years of taxes. If, let's say you made more money in 1 year than the other, then that also help your income qualification. Is that correct?
What they're going to do, depending on what type of, if you're a wage earner, if you're salaried, or if you're hourly. So we're going to, and if you're hourly, are you working 40 hours a week? If not, then we're going to look at it as variable income, and we are going to average probably the current year and the last year. And that's why we ask for 2 years. So then we send out what's called a verification of employment, or pull the information from the work number. We're going to overtime to give you the overtime over a 2-year period, commissions, and to look at your base. Your salary is going to use salary, but if hourly, if you're working the 40 hours a week, then I'm going to use 40 hours a week. But if you're not, if it varies, then I'm going to use the lower number. I'm gonna take current year plus the prior year and average that. So that can affect you.
Okay, so there you have. So you want to at least maintain income, salary, wages, and or self-employment income, whichever it is, to try to maintain that stuff so you can have a decent average when they do both of those years. She-Ra has had a question over here. Yes, I really wish they would have taught me this when I was in school. I would definitely be on multiple properties by now. All right, guys. So it is not too late now that you know this information. Right, Brenda? They can go ahead and put it into effect now. Get it going. You have 2021. Pull it together now. Look at your credit score and work on that now, and so that in the next year or so you are able to qualify to purchase, right? So okay, so guys, again, how to qualify to purchase real estate, and we're happy to have Brenda here to explain all this to us. I'm going to go over the points real quick, and then I'll see if Brenda wanted to add some more to any of these points. And of course, keep putting your questions on here. It's never too late. That's right, Margie, it's never too late. Thank all of you guys over here on IG. Appreciate it. So how to qualify to purchase real estate, guys. 4 points we talked about today. Very important. The credit score. And we all know what that is, and we all have to work on that. Again, make sure that it's decent. You bring it up to an average score. And Brenda, while I'm saying this credit score, is there like a standard minimum credit score that works best?
We'll go on an FHA loan. We'll accept as low as a 580 FICO score. But now remember, at a 580, we're probably talking about your interest rate is going to be much higher than a person who has 700 FICO score. And it depends on what value is. But conventional financing, 620 is the minimum. And what I'm seeing right now, to get a conventional approval, I'm seeing that you should have a minimum of 680, probably almost 690 to get a conventional approval. And I would say that's what we're looking at right now. But normally conventional 620 is what's required. And FHA will go as low as 580. But you don't want to, if you can, you want to be a much higher, so you get better pricing.
All right. So there you have it. Those are scores that you want to try to make sure that you gear towards. And of course, the higher the score, the better it is, the better the interest rate is. And the better the interest rate is, your buying power is better. You pay less of a mortgage in a much more expensive home. Okay. All right. So that's the first point, the credit score. Second point today is income. And we talked about, Brenda mentioned what the income, what it qualifies you for based on how much your income is. It qualifies you for a certain amount of property purchase, buying power, I guess that is called. And then the third point today was the debt to income ratio. And we talked about, the more debt you have, of course, the more income you need to have. Of course, the lower the debt, the income works better, and your credit score looks better, your interest rate is better, and you can get into a much more expensive home. And then the fourth point today is the taxes. Of course, again, they have to be filed. For the most part, lenders are looking for 2 years worth of tax returns, guys. Again, very important. Get your taxes filed. Haven't filed on time, because I've seen a lot of cases where when it's time to close a loan or time to the taxes are not there, pulling that transcript become an issue. So you want to make sure that you get your taxes filed on time, right? Okay, Brenda, anything else you want to add to this, you guys? Any other questions you guys put it in the chat? We'll come back through here and get them. Anything else you want to add in closing, Brenda, to our viewers out there?
So I would just reiterate, if you do not have a copy of your credit report, don't have a lot of different just run your credit report. That can lower your score. You can go on annualcreditreport.com and get a free copy from each of the bureaus once a year. So pull your credit report, because there might be some things that are inaccurate and that you can correct, especially if you're looking at maybe purchasing or even refinancing. You want to have the best score that you possibly can have. And sometimes, even though we ask for 2 years tax returns, if you're a first-time home buyer, I'm going to ask you for 3 years, just because the definition of a first-time home buyer is someone who's not owned a home during the past 3 years. So I just want to answer whatever questions, and if we can teach our young people go out and buy that car first before they get pre-qualified and purchase their home, then we're handing off or teaching our young ones how to generate wealth. So if there's any questions, just give me a call. And I enjoyed the show. Thank you.
All right. And Lerner Smith says, get your taxes filed at Proby's Tax and Accounting. All right, that's right. That's what we do over here for the last 30 years is what we've been doing. So yes, Ari, we are here for that. Cherie says, is there a top-off credit score number? For example, anyone with a score above a 740, the interest rate is the same. So I guess is 740 and the highest score, the 800, is that like the same rate? I think that's the question. Brenda?
I would say when you're at 760, a person at 760 is probably going to get the same rate my person at 800 is going to get.
Okay.
It's going to now depend on your loan to value.
Okay. So there's the answer to your question, Sharice. All right. I've enjoyed this. This has been awesome. Excellent information, guys. Make sure that you guys hit like and share on this video, and make sure that all your friends and all family and everyone get a hold of this information. Again, we all agree that this is something that we should know from an early age, and some we can pass it on to our young folks so we don't go through the high and lows with the credit score, and getting all the other part of that is getting all these credit cards, which we all was guilty of. I remember having every credit card in town, and you run them all up, and that was the worst thing to do. You have to pay them all back down. So let's just start this off great. Cherie said thank you, Brenda. All right, so I think, guys, this is awesome and amazing. You can reach us here at Proby's Tax and Accounting, 323-290-9034. And visit us at our website at probystax.com. And Brenda, is there a direct number or line you would like if anybody have any questions regarding how to get qualified, pre-qualified, that they can reach you at?
Oh, sure. I can be reached at 213-309-5698. Again,
All right.
213-309-5698. Thank you.
All right, there you have it, guys. So make no mistake, let's get on the right path. Let's acquire real estate and be on our way to acquiring wealth. Okay, and let's pass it on to our young ones, and reach out to our friends and family. Okay, so Lerner said, excellent, needed information. Thank you so much. I want to thank all you guys for jumping on here today. As always, keep your notification on. We have more information for you guys coming through as far as wealth building. Next week, we'll be talking about insurance and what effect that has on helping us to build wealth. These are things that we do have to talk about, and a lot of times, a lot of this stuff goes unnoticed. So tune in again next week. I'll see you guys back here next Tuesday with some other great information. Learner says 213. Okay, that's Brenda's number, 213-309. Okay, there it is on the screen, you guys. You can reach Brenda regarding real estate mortgage loans. Okay. All right. So that's it for us today. Karen says, very good information. Appreciate you, Karen. Cause for Pat, thank you. All right. Thank you, Cognac. Thank all of you guys over here. Thomas Zero. Again, we will be up out of here. Margie had said something. She said, thanks, ladies. Appreciate your time and services to our community. You're very welcome, Margie. Very welcome. I think with that said, we have covered it all, right? So I'll come back through here. Brenda will be back through here. Answer any questions anyone else have, correct?
Yes.
All right. Okay, so there you have it, guys. With that said, you guys have the wonderful rest of your Thursday afternoon. Have a fabulous weekend. And you guys take care of each other and take care of yourself. Bye-bye.